The new Monetary Policy Committee of the Central Bank of Nigeria, led by Olayemi Cardoso, the central bank chief, delivered a 4% hike on policy rate to a record 22.7%. The committee also took cash reserve ratio to 45%, but holds liquidity ratio at 30%, while adjusting the asymmetric corridor of the anchor rate to 100 plus 100 minus 700 basis points. And there is more in the post-MPC press briefing held by the central bank governor a few hours ago. Let's bring on my panel on this. Professor Ken Ife is a development economist in our Abuja studios. And here in Lagos with me is Kelvin Emmanuel, economist and member of the board at Obsidian Archina Nigeria. And joining in the conversation also is Benjamin Boachie. He's the chief economist at Second Stocks in Accra, Ghana. Good evening, gentlemen, and thank you for coming through tonight.
Good evening. Thank you so much.
Thank you, Kelvin. And thank you so much over there in Ghana. Professor Ken, thank you for coming through tonight in Abuja studios. Let me start with you, Boachie, looking in outside from there in Ghana to Nigeria. What do you make of today's central bank rate decisions? You're the one outside the shores of this country. So let's start with you.
Oh, yeah. I mean, the rate hike was a bit overdue, but it's certainly a step in the right direction because adjusting the policy rate is pretty much the best tool that the central bank has in its arsenal to tamp down inflation. So it was good to see them take a robust step in the right direction with the 400 basis point jump. I wasn't sure they would go that far, but I'm pleased to see that they did.
Oh, great. So that's a curtain raiser. Thank you so much, Benjamin. Kelvin, is this the big hike in MPR and cash reserve ratio in line with your expectations?
I'm not surprised they raised the MPR. I think it's a step in the right direction, tighten monetary policy.
Were you expecting 400 basis points?
Well, I was expecting 250 to 300 basis points, but 400 basis points is actually welcomed. You know, the inflation to interest yield curve differential is still at 7.1%. And then they left the asymmetric corridor at 600 basis points plus 100 minus 700, standing deposit facility rate and standing deposit rate. And this is following the fact that last year, CBN lifted the limit for which banks could deposit money, monthly limit of 2 billion naira up. So in a situation in the markets, for example, where commercial lending rates are going to go up at between 32 and 35%, and the non-performing loan ratio book of banks are going to rise up, and it's going to be more difficult for banks to offer credit to their customers. Banks are going to fall back to Treasury. I am a bit not sure on what the strategy is, raising the cash reserve ratio to 45%, because before 2014, cash reserve ratio was between 8 and 12%. In 2015, cash reserve ratio was 15%, which is in line with the global market average Basel standard of 15% for cash reserve ratio, and it's been raised. So, cash reserve ratio is a way the central bank uses to monitor supply of money in the system. CBN is talking about end-term money supply that comes from FX differential in the debt securities markets, and in the equity capital markets. But the question I have for them is, if you're raising cash reserve ratio to 45% and you're leaving your liquidity ratio at 30%, your liquidity ratio, which basically measures your highly liquid assets in cash, in treasury bonds, and in corporate debt, over your net cash flow. If you're leaving it at 30%, what room are you creating for
for transmission of credit
exactly.
to the
so
economy?
I'm a bit not sure about the strategy of raising your CRR to 45% and leaving your liquidity ratio at 30%.
Let me take this straight to Abuja. Professor Kenife, give me a development economist view of today's MPC rate decisions based on the state of the economy for Nigeria right now.
Yeah, the action taken by central bank has long been expected, and they have actually been saying it, that they are going to focus on inflation targeting repeatedly. I was expecting substantial rise in monetary policy rate, around 3% or so, being my most optimistic view. I didn't know it would go as much as 4%, but that is okay. But then also to now raise the cash reserve ratio means that it is a total assault on using the best instrument that they have in this particular case, which is using the MPR. Both of those two instruments are used, but I'm not sure they are going to touch the loan to deposit ratio, because that is already high from 55, 60, 65%. But anyway, The other macroeconomic variable that could be affected is growth, obviously, because what that happens is that banks will start repricing their assets. Those who have variable loans are going to see dramatic increase in their interest rates. And then you're going to also see manufacturers and service providers struggling in terms of availability of cash. And that is going to transmit to a smaller pot of money available to banks to lend, if at all. And even if they lend, they have to now lend at a significantly high interest rate to spread across over 75% of their money that are held back out of action. 45% is sequestered in the central bank. The other one you have to keep and other stuff. But again, too, the bank has gone out 3 times on an open market operation to suck out oxygen from the system before now bringing this in. So it's not going to be fantastic news for the banking sector. But the manufacturers are also going to struggle. And that means a knock-on effect on employment, which is the third variable, macroeconomic variable. The employment is not going to show great signs, at least for now. But in terms of the inflation, which is our main target, I know that 4 indices are going to come down. The headline inflation will come down, core inflation will come down, urban and rural inflation will come down. But I'm not very sure about the food sub-basket index, because what happens is that there is a component of imported food in that sub-index, which is also there in the core index. So any prices of imported goods are likely to go up. But the real case against food sub-basket index is that we are surrounded by nearly 100 million Francophone citizens across all our borders, and they are buying, they have a price advantage, and they have elasticity of demand. And with the currency differential, so they're importing our foods and all the things we produce at a price differential that's, is artificial. Their currency is very artificial. France is burning 80% of their reserves to maintain that currency, that CFA, with the euro. So it is an artificial value. So when Nigeria is now our currency, naira,
yes,
I used to buy 4 francs CFA now,
yes,
they couldn't even buy 1. So it's like 80% devaluation from. So that particular side, which is a demand pull inflation, is going to continue to haunt us. And that is why that particular element cruises at over 35% inflation.
So Professor,
we'll have to see. And unfortunately...
Yes, Professor, just a minute. We'll come back to you just a second. I'm just going to ask Benjamin in Accra. If this rate, Benjamin, you're a chief economist at Second Stocks, is this rate increase the silver bullet that will unlock foreign portfolio investors' FX into Nigeria? Is this all everyone's been waiting for? Do we have it now?
Well, obviously we need to wait and give it time to see how the policy rate adjustment factors or trickles down and passes through the economy. So no, it's certainly not a silver bullet. And relatively speaking, between Nigeria and a lot of other countries that foreign direct investment might target, the global inflation picture is starting to get better. Inflation is coming down pretty much around the world. So you still need to wait and see if inflation comes down in Nigeria to make that real return kick in the way that the global investors are going to want to see. What I had hoped to see was something of a dot plot, just a forecast of what the policy rate trajectory might look like and what the factors that they're considering are, what the metrics are, what the criteria is that they're using to make those decisions going forward. Because if we got a clearer picture of what the future trajectory of the policy rate looked like, we could get a better handle on animal spirits and just future expectations of inflation. Because those.
Yeah, I love that animal spirit. If we can just unleash it on the side of the FPI. So tomorrow, the Central Bank Governor will be doing a conference call with foreign portfolio investors. Just a second, let me stick with you. What are you looking to hear? What do you want to hear tomorrow from Cardoso? Oh, sorry, that's been moved to Thursday. So what do you expect to hear from that conference call?
Well, okay, so there are two things, right? One, this is a new central bank governor who's managing the largest economy on the African continent. I want to understand his personal philosophy about how to adjust, how to set policy rates and so on. So, like I said, I need to understand what he envisions the trajectory of the policy rate to be and how he expects to get there. What metrics he's using to make these decisions, and what how exactly he's going to say that his goals are being achieved, right? So that's probably the most important thing I need to understand from hearing his call tomorrow.
Interesting, Kelvin. Let me come back to Lagos Studios here with you. In the stock market, dived nearly 1.4% today. So what are you looking to see from tomorrow when we get back to this cash reserve ratio that is going to strangulate the banks a little bit further, as it were? We're talking about this credit to the economy that we need. This delicate balancing in terms of inflation, growth, and investment that we need.
I think the banks are in a fix, in a very tough spot. I don't know if the banks were expecting a decision, because definitely you having to park 45% of all deposits with the central bank means that you have little wiggle room, and you're definitely going to see, with the increase of 400 basis points, you're going to see non-performing loan book go up.
So OVN,
yes,
OVN went up that strategically today.
Yes,
that's it. Do you think the market is beginning to feel that?
It is beginning to feel it, and especially in a year where the banks have to recapitalize their minimum capital requirements.
Yes.
And where asset quality is being reduced, and it's affecting their, liquidity ratio, is affecting their capital adequacy ratio. In 2024, the banks will have to dramatically increase their minimum capital requirement because of the gearing ratio. So you having a situation where there is huge imbalance in their non-performing loan ratio, and it's affecting their total risk-weighted assets. And look at the total capital over total risk-weighted assets and the quality of the assets they have on their balance sheet. It's really, really a tough call. I don't expect that the banking stocks, most of them were red at the close of trading on the NGX today. I don't expect that they are going to feel this impact for a while.
Very, very interesting. Professor Kenneth, let me get back to you in Abuja for this conversation. What other macroeconomic and fiscal issues are necessary and urgent for Nigeria, Professor, in the near to medium term in order to balance this big jump in policy rate? President Tinubu is very, very keen. He's doing a whole lot fast and furious right now. The central bank is also firing almost every minute, every second into the BDCs, into the market. And what of you? So, do you think we have all it takes now, all irons in the fire, in a manner of speaking, right now, to have this growth that we sorely need? Mr. President needs growth on one hand. It needs lower inflation. He wants to see interest rates also lower, but things are not looking that way right now.
Well, the thing is, it's going to be a bit tough, though. You have to excuse the central bank. The central bank has to do what it has to do, because it has those mandates on price stability, and it has to tackle it head on, and it's doing that now. There's always a consequence when you tighten in a very dramatic way. There's always a consequence. I've already mentioned two of them: the impact on cost push inflation, and then also prices are going to be affected. And they also talk about employment that may suffer a bit. But there's a fiscal response too. And then secondly, in investment, the area of investment, you're going to see a move to fixed income, because people are going to want to move their money away from equities and go to fixed income, where they will just take comfort on the increase, on the hike in the rates. But having said that, even without this measure, already the central bank has signaled that they are withdrawing from domestic finance intervention. So that means that there is going to be a gap already. So we may have to find that gap in some recapitalization of banks, and the recapitalization of the likes of Bank of Agriculture, and then already Bank of Industry is trying, but we need to have more. And then, of course, if you have other financial developments to coming in, it will be very, very helpful. But the agriculture, that is the crux of the matter in terms of inflation, if you look at the headline inflation versus the food basket sort index, that agriculture will be a big challenge. So there's a fiscal intervention route. We've seen 600 billion coming from going to Ministry of Agriculture. We have another 1 trillion, 600 billion. You have 100 billion going into Agriculture Development Fund. So you have some fiscal support coming in. And then we just hope that minus the insecurity that is threatening agriculture in all ramifications, that we will see agriculture, get a breath of fresh air. But otherwise, that is where I have the greatest concern. Investment, we know there will be challenge. In employment, there will be challenge. In import, import again, we can't actually be very sure what will happen. But if impact on Forex, there may be some impact on Forex, because what you are doing now, you are sucking away the oxygen from the liquidity of both the central bank, commercial banks, and all these speculators that are using Naira to speculate on dollars. So there may be some impact there. So whatever comes through is going to be coming in as a higher price, because our products are going to get even higher. The cost of Nigerian export is going to be higher. So don't expect that we are going to export more. Okay. So in that circumstance, there's going to be an inflation pass-through.
Okay. So Professor Benjamin and Kelvin, our final point, I want each of you to take about 30 seconds or so to discuss this interest rate hike. Does it take Nigeria closer to a Eurobond flotation? What's your outlook? Do you think we can get to the market anytime soon with what we've just done? What do you think the scenario will be? Benjamin, you have 30 minutes in Accra. Talk to me.
I don't know that it immediately takes us closer to a Eurobond, because that's a question of market appetite. And there's still several headwinds, facing the Nigerian economy. So I think you need to give it more time. You need to get the inflation picture stabilized. You need to target growth with fiscal policy, and then maybe a little ways down the road, we can start looking at bringing in some Eurobond.
Kelvin, what do you think?
I think you have to look at the fact that Moody's is currently CA1, it's junk, not prime. Fitch is B minus with a stable outlook. I think that's been revised. You have to look at the credit default swap. You have to look at the country risk premium. And then you have to look at the position of the central bank in terms of their net reserves as compared to the balance of trade for 1 year. And you have to look at the revaluation losses on swaps and forwards that the central bank has, which I estimate to be anywhere around $12 billion.
So we're not back in the Eurobond market anytime soon?
I don't think Nigeria can go to the Eurobond market in 2024. And you also have to consider that in 2025, they have a $1.2 billion maturity
to deal with.
So I think creditors will want to look at how the Nigerian government is able to handle that first.
Before they
want to come back.
Great. Thank you, Kelvin. Professor, let me finish with you. Can you give me this in 30 seconds or less? What do you think we should do with our creditors right now with this inflation? How do you think they're looking at us?
I don't think the accretion to our reserve will be enough to meet the quantum of demand for reserve now. So we're going to have to go to the capital market. Already is already in the borrowing plan for the government.
Yes.
Government is trying to keep away from crowding out private sector investment. So they are going to have to go there. And then the last outing was oversubscribed. So the temptation to go would be there. And then we need to get some of that to be able to service our loans and be able to do other things. So it's a possibility.
All right, let me thank you all my panelists for your robust contributions to this big development in Nigeria today. Thank you so much, Emmanuel Boachie, Chief Economist at Second Stacks in Accra, Ghana. Thank you so much, Professor Kenife in our Abuja studios, and Kelvin Emmanuel, Economist and member board at Obsidian Achina, Nigeria. Thank you very much. You do have a great evening.